You can close out the fiscal year with millions in net profit, yet have absolutely no idea how to price your next individual product. It happens every day in high-volume manufacturing. To solve this specific blind spot, operators run two entirely independent sets of books. They use financial accounting, and they use cost accounting. As this diagram shows, both systems share the exact same foundation. They process common vouchers and rely on double-entry accounting to calculate profit. But their goals diverge. Financial reporting presents the business to external users, while cost control looks inward for internal planning. This creates an obvious dilemma. If both systems calculate your final profit using the exact same stack of receipts, why would any business spend the time and money to maintain two separate ledgers? Because relying strictly on financial accounting is a legal necessity, but it leaves your operators completely blind to the mechanics of individual units. Trying to make daily production decisions using only your financial accounting is like driving on a racetrack using only the rear-view mirror. You will stay legally compliant, but you will crash the car. The first major trade-off between these two systems comes down to timing. Looking at our comparison matrix, financial accounting has an annual perspective. It waits until the end of the year to aggregate operating results. That delay serves a purpose, producing a highly accurate, legally compliant snapshot for external audits. But for operators, an annual perspective is useless. If a specific production line starts bleeding cash in March, waiting until December to see the data means you cannot stop the bleeding mid-year. Cost accounting fixes this by generating reports voluntarily, on demand. You get the numbers exactly when management requests them. That rapid reporting allows a manager to catch overruns on Tuesday, adjust budgets on Wednesday, and pivot by Thursday.
The cost of this agility is internal overhead. You have to hire people to maintain a secondary, highly active tracking system that the law does not even require you to have. Financial timing prioritizes historical accuracy. Cost timing prioritizes immediate operational agility. The second major trade-off between these two accounting methods lies in granularity, specifically looking at how deeply each individual system categorizes your daily expenses. Financial accounting aggregates data. It takes your manufacturing, office, selling, and distribution costs and subjectively combines them into one massive pool of commercial expenses. This aggregation yields the net profit or loss for the business as a single entity. The danger is that an aggregated view hides silent killers. A highly profitable product line can subsidize the massive losses of a failing product line, while the aggregate total still shows a net positive. Cost accounting narrows the scope. It breaks down costs objectively, isolating the expenses going directly into production. By isolating data on a unit basis, cost accounts reveal the exact profit or loss of every individual product, job, or service. However, because cost accounting ignores broader office and selling expenses, a positive margin on a single unit does not guarantee your entire company is healthy. Aggregate financial data tells you if your business survived the year. Granular cost data tells you exactly how you survived it. The third and final major distinction between these two systems comes down to the strictness of the rules governing how the ledgers are maintained. Financial accounting is a positive science. It operates under strict corporate law, relies heavily on case decisions, and records only absolute monetary facts. This rigidity is a feature, not a bug. It ensures regulators receive a highly defensible, universally understood document. But historical monetary facts do not capture the relative efficiency of your workers or machinery. If you only look at the rigid financial data, you have no benchmarks to improve daily operations. Cost accounting solves this by blending actual facts with estimates. It uses non-monetary information, like tracking units produced per hour. This blend turns it into a normative science, allowing managers to deploy standard costing and strict budgetary control. Financial accounting legally proves what actually happened. Cost accounting sets the standards for what needs to happen next. So, how do you match the correct accounting framework to the specific business problem in front of you? Keep the distinction simple. Financial accounting exists for external validation, while cost accounting exists for internal optimization. You rely on your financial accounts when you need to prove your overall viability to a bank to secure a loan.
You also use them to survive external tax audits and legally satisfy requirements under the Companies Act. But when you step onto the factory floor or plan your next quarter, you need the operator's toolkit. You pull from cost accounting to identify plant inefficiencies and price a new service line. It is the only tool giving you the data to keep or kill an existing product and accurately assign financial accountability to individual departments. If you ask a legally bound financial ledger to do the agile, granular work of a cost accountant, you set your management team up to fail. Building a robust cost system requires a significant voluntary investment of effort. You have to get comfortable with estimates and non-monetary figures. But investing that effort to track granular data is the only reliable way to turn legally compliant paper profits into actionable, real-world business control.